Silver just pulled off a move that can make you feel like a genius and an idiot in the same 5 minutes. I'm talking about a market that looked calm, then went absolutely vertical, and then, right when everyone thought the party was just getting started, got punched in the mouth so hard it left a crater on the chart. And if you're thinking, okay, so was that the start of the next leg up or the top? That's exactly the question. Because what happened today is rare, messy, and incredibly revealing if you know what to watch. It's Tuesday, January 27th, 9 a.m. in New York, and I want you to comment what time you're watching this from wherever you are, because the next 48 hours could look completely different depending on when you hit play. All right, let's get into it. Silver just printed one of the biggest single-day jumps most people alive have never seen in real time. The session ran up to $117.84. Read that again, $117.84. And then it didn't just cool off, it slammed back down like someone yanked the floor out from underneath it. As I'm recording, it's still green on the day, but the speed of the pullback should make your ears perk up. And I'm not saying that to scare you. I'm saying it because that kind of whipsaw is information. It's the market whispering, actually screaming, pay attention to who's trapped, who's chasing, and who's unloading. Now here's the part that messes with your head. Overnight, price wasn't acting like a rocket ship. It was behaving almost normal. It floated above $108, it tagged $111 in the quieter hours, and it didn't look like anything was about to explode. Then the bell rang, volume woke up, and silver went from steady to unhinged in a straight line. The volume bars were the giveaway. At first, you could tell the buying was controlled. Then the activity ramped and the candle started stretching. And then there was that moment, if you watched it live, you felt it, where every tick higher pulled in even more buyers. That's when charts stop being charts and start being psychology experiments. And then, right at $117.84, it was like gravity got turned back on. The selling didn't dribble in. It hit like a wave. If you've ever seen a liquidity vacuum, this was it. Price climbs, stops get layered, and then a single push flips the whole thing into a cascade. And let me unpack what cascade actually means in plain English, because this is where a lot of people get confused and then make the exact wrong decision. Silver trades in different pockets of liquidity depending on the hour. In the quieter overnight session, you can have price drift higher on relatively light activity. That's why it can feel stable even while it's climbing. But when the main session opens and the big players show up, those pockets connect, and the market suddenly has to reconcile a lot of conflicting orders at the same time. That's when the stop map matters. Above obvious levels, round numbers, prior highs, breakout points, there are usually buy stops from shorts and buy stops from breakout traders. They're different motivations, but they create the same type of order, a market buy. If enough of those trigger in a short window, you don't get a smooth rally. You get a surge. And here's the twist. The surge itself creates more stops. Traders who are long decide to protect profits, and they put stops below the market. Shorts, who re-enter too early, put their stops just above the market. The market becomes a Jenga tower made of stop orders, and one shove can topple it. So when price hits an extreme like $117.84 and then snaps back, it's often because the buy stops are done. The forced buying has finished. At that moment, the market has to stand on real demand. And if real demand isn't waiting at that exact price, the only way to find it is to drop until it appears. Now, add options into the mix and it gets even more dramatic. When a market rips through big strike prices, the dealers who sold those calls may need to hedge by buying futures. That hedging can accelerate the move up. But if the move stalls, the hedging pressure can flip, and that support turns into selling. It's like the market is running with a tailwind and then somebody spins it around. This is why parabolic candles often come with the ugliest wicks. The wick isn't random noise. It's the footprint of forced flow colliding with reality. And if you're wondering whether the move was real or fake, I'd argue that's the wrong question. The right question is, what kind of participants were dominant during the move? Was it patient buying or urgent buying? Because urgent buying always runs out of breath. One more thing before we move on. When you see a move this big, pay attention to the front month versus the next month. Sometimes the nearest contract gets whipped harder because it's where the liquidity is concentrated. Sometimes it's the opposite because traders roll. Either way, the microstructure can exaggerate the headline number, and that exaggeration is exactly what triggers emotional decisions. So if you felt your heart rate spike watching that candle, congratulations, you're human. The goal now is to become a little less reactive than the crowd. A big financial outlet called it the biggest one-day surge since March of 1985. That's 40 years of normal market behavior being tossed in the trash for a day. And if you're new to watching metals, that date matters for one reason. Moves like this don't happen in boring, balanced markets. They happen when positioning is off, when leverage is heavy, or when the underlying story is shifting faster than people can adjust. Now, before you start thinking this is only a silver story, look around the room. Gold also spiked to a fresh record today, touching $5,110.90 before backing off. Platinum got smoked, down hard after hitting an earlier high, and palladium got clipped too. Rhodium was the odd one out, staying strong when the rest of the complex looked like it got hit by crossfire. And the gold to silver ratio? Still under 50, sitting around 47.84 last I checked, and at the peak of the spike it flirted with the mid-40s. That's not a normal reading. That's the kind of number you see when silver is either entering a new regime or when it's overheating so fast it can't breathe. And to really understand why that ratio reading matters, you have to remember how silver behaves when it's leading. Silver is the smaller, more volatile sibling. When it starts outperforming gold aggressively, it can be a sign of broad commodity inflation, or it can be a sign of speculative heat. Historically, the biggest silver stories start quietly. Gold moves first, confidence builds, and then silver catches fire. The danger zone is when silver starts sprinting so fast that gold can't keep up. That's when the ratio collapses and everybody starts using the word inevitable. I've watched enough cycles to tell you, nothing is inevitable in this market. Silver can be right long term and still hurt you short term. Here's another layer that doesn't show up on a simple ratio chart, where the demand is coming from. Investment demand can explode quickly, but it can also reverse quickly. Industrial demand is slower, but it's persistent. And silver has been quietly gaining strategic importance as manufacturers try to build more efficient electronics, expand power grids, and scale up solar and data infrastructure. You don't need to memorize a spreadsheet to understand the implication. If industrial usage is steady while investment demand surges, the price can do things that feel unfair. But if investment demand fades while industrial demand stays steady, the market can still fall, just not all the way back to where it came from. That's how you get a higher floor over time. On the supply side, most silver production is tied to other metals. That means even if silver prices jump, miners can't instantly double silver output, because silver is often a byproduct of mining something else. That's one reason silver can gap higher in short windows. The supply response is sluggish. And when people argue about whether $100 silver can stick, this is the real debate underneath. Not the headline, not the hype. The debate is whether the market is transitioning from investment-driven spikes to structural tightness. If it is, the old playbook doesn't work the same way. But again, don't let the big picture trick you into ignoring the next few days, because markets can be structurally tight and still flush 20% in a week if leverage gets too heavy. That's what makes this moment so dangerous and so interesting. So what does this mean? I'm going to give you two clean frameworks for understanding today, and I want you to decide which one is more believable by the end, because both can be true in different time frames. And the difference between making money and getting chopped up is knowing which time frame you're actually trading in. First framework, the bullish case. This is a breakout, not a blow-off case. If silver can live above $100, it changes the entire conversation. Psychologically, $100 is a line in the sand. It's not just a number, it's a headline machine. It's where casual money shows up, where momentum funds pay attention, and where industrial buyers start doing uncomfortable math on long-term contracts. And technically, once you clear a century mark, there aren't a lot of nearby reference points. There's no, oh, we topped there last year, memory for the market to lean on. It becomes open water. That's why you saw people talking about $120 like it was the next obvious magnet. In chart terms, it's basically, if we hold this, the next logical shelf is up there. But here's what most people miss. The trigger isn't only a line on a chart. The trigger is the macro calendar. This is a week loaded with risk. You've got a major central bank decision looming. You've got political noise about budgets and shutdown threats, and you've got another round of headline roulette that can smack the dollar around. And yes, the dollar matters. Not because it's dying tomorrow, but because short-term moves in the dollar can yank metals around violently. The dollar index dipped into the high 90s, around 97.05 on my screen earlier, and that weakness can act like lighter fluid for metal rallies, especially when traders are already leaning the same way. Now I'm going to add something here that wasn't part of the chatter earlier today. The real driver under the surface is the rate story. When real yields soften, metals don't just drift up, they can rip. And from recent market updates, you can see traders pricing in a path where inflation doesn't fall as cleanly as people hoped, while growth keeps wobbling just enough to cap how aggressive rates can stay. If you want a simple mental model, it's this. When cash feels less safe and bonds feel less predictable, hard assets get more attractive, even to people who don't love hard assets. That shift doesn't happen in a straight line. It happens in bursts, usually around big policy weeks like this one. And silver has an extra layer that gold doesn't. Silver isn't just a store of value story. It's an input. It's in electronics. It's in infrastructure. It's in the energy transition. Based on recently published numbers on industrial consumption trends, the demand profile has become less seasonal and more structurally sticky than it used to be. And that matters when inventories are tight and supply growth is slow. So in the bullish framework, today's spike is the market testing the ceiling, flushing weak hands, and setting up for a higher base. In other words, the wick is scary, but the message is the market can get up there, and now it has to decide if it wants to build a runway. And if that's the case, the pullbacks are not the end, they're the reload. But here's the cliffhanger. The bullish case only holds if one specific thing happens next, if silver can stop falling while volume cools. If volume stays elevated while price slips, that's distribution. If volume fades and price stabilizes, that's consolidation. Same chart, different meaning. And we're going to know which one it is faster than most people think. Now let's switch to framework 2, the skeptical case. This was a blow-off and the market just showed you the exit sign case. This view says today wasn't healthy price discovery. It was stress. It was a short squeeze, a stop run, a margin panic, or some combination of all three. And when moves like that happen, the price you see at the top is not a fair value. It's a momentary print created by thin liquidity and too much leverage. Think about what it takes to go from the low hundreds to $117.84 in a flash. That's not grandma buying a few ounces. That's concentrated flow, big orders, aggressive algorithms, options dealers hedging, and traders chasing because the chart looked like it was breaking the laws of physics. Here's a clue. The pullback wasn't slow. It wasn't thoughtful. It was violent. And violent reversals usually mean someone got forced. Either longs were forced to puke, or shorts were forced to cover at the top, or both. And when people talk about meme traders or social media mania as the reason, I want you to be careful. That's an easy story. It's a convenient villain, but it's also a lazy explanation. Could retail be involved? Sure. Retail is always involved when a market goes parabolic. But retail rarely creates the first shockwave in a market this deep. Retail can amplify. Retail can chase. Retail can add fuel. But the match is usually struck by positioning, not by a hashtag. A more realistic alternative is this. The market was already leaning. Shorts were already uncomfortable. Options exposure was already stretched. And once price popped above certain levels, mechanical buying kicked in. Trend systems buy when momentum triggers. Dealers hedge when calls go in the money. Stops get hit. And suddenly, you have a chain reaction that looks like mystery demand, but it's really a series of forced actions. Then, once the squeeze hits a point where liquidity providers pull their bids, the same systems that chased up can flip to risk off. And that's how you get the signature move we saw, a skyscraper candle and then a cliff. In this framework, the high print is the warning. It says the market can overshoot insanely, but it also says the market is fragile. And fragile markets can drop farther than you think, faster than you think, even inside a bigger bull run. Now here's where the skeptical case gets even sharper. A lot of people hear, later this year it could be half the price, and they laugh, because it sounds extreme. But if you've studied historical silver runs, you know silver doesn't do gentle pullbacks after explosive moves. It either digests sideways for a long time, or it snaps back viciously and steals your confidence. We've seen versions of this movie before. In past cycles, silver has had days where it looks unstoppable, only to spend weeks undoing the hype. And what that does is it separates conviction from leverage. The metal doesn't have to fail for the trade to fail. Leverage fails first. So the skeptical case says, don't confuse a headline print with a sustainable level. Don't anchor to $117.84 like that's a new floor. It might be a spike that disappears from your emotional memory faster than you expect. Here's the next cliffhanger. If this was a blow-off, you'll see it in one place before you see it in the spot price. You'll see it in how the market behaves on the next dip. Does buying show up early and calm, or does it vanish until the price is much lower? That one behavior tells you whether strong hands are accumulating or whether everyone is just waiting for the next panic. Now, I promised I'd keep the progression clean, so let's bring it back to what you can actually track without needing a fancy terminal. Number 1, watch the dollar. Not as a religion, as a signal. If the dollar catches a bid after the policy decision this week, metals can get slapped. If the dollar stays soft, it gives silver room to stabilize and possibly retest highs. Number 2, watch rates. If bond yields jump because policymakers sound tougher than expected, silver can get squeezed from the top and bottom. If yields drift down because the market senses more caution, silver gets oxygen. Number 3, watch volatility. When silver whips like this, volatility expands. That changes margin requirements, it changes position sizing, and it changes behavior. From the latest publicly available exchange notices and risk controls, these markets can tighten conditions fast when things get disorderly. And when that happens, it can force people out even if they're right long term. Number 4, watch the gold to silver ratio. People treat it like a magic number. It's not magic, but it's a great thermometer. When the ratio collapses fast, it usually means silver is doing the risky, emotional part of the bull move. That can be bullish, and it can also be the late-stage froth. The ratio doesn't tell you direction by itself. It tells you intensity. And if you want an extra, very practical read on whether this move has real legs, watch what happens in the physical world and the simple proxies people use. When silver is truly tight, you'll often see physical premiums stay elevated, even if the paper price wobbles. You'll see delays, rationing, or sudden out-of-stock signs. You don't need to name any brand to see it. You just need to pay attention to the behavior. You can also watch broad investment flows. When large funds add exposure, it tends to show up as persistent buying across multiple sessions, not just a single spike. If today was purely a squeeze, you'll often see that follow-through fail. If today was the opening of a new phase, you'll see dip buying that looks boring and consistent. And finally, watch how miners and related equities react. Sometimes the metal spikes and the stocks don't confirm. That divergence can be a warning that the move is more technical than fundamental. Other times the equities lead, hinting that smart money is positioning for a longer run. That relationship isn't perfect, but in weeks like this, it's another flashlight in a dark room. Now let me pause and put something practical on the table. In markets like this, buy every dip is not a strategy. It's a slogan. A strategy is pick levels, pick time frames, and pick a risk point where you admit you're wrong. Because yes, dips can be opportunities, but not every dip is a gift. Some dips are trap doors. So here's my question for you, and I want an actual answer in the comments. Do you think that $117.84 print was the market showing you its destination, or was it the market showing you its limit? And here's a second question, because I'm genuinely curious how you're thinking. If we finish the week still above $100, does that change your outlook, or do you still expect a deeper reset first? By the way, if you caught that spike live, tell me what you did. Bought, sold, froze, or waited. Those choices teach more than any chart today. Now, quick housekeeping that won't kill the pacing. I put bonus links in the description, including a premium WhatsApp channel link and a channel membership join link. If you want the fast updates and the extra material without digging around, it's all sitting right there. And speaking of membership, we also do members-only videos. Those are produced by a separate team that goes deeper, with more research and tighter data work, and they're only for premium members. If you're the type who wants the receipts and the deeper dive, that's where we put it. All right, back to the action, because this next part matters. When silver makes a move like today, people immediately hunt for a single cause. It was this headline. It was that comment. It was the shutdown. It was the central bank. And I get it. We like clean explanations. But markets don't move on one reason. They move on stacks of reasons. So let's stack them. First, uncertainty. This week has uncertainty in multiple directions: policy, politics, budgets, and the overall tone of risk assets. When uncertainty spikes, money crowds into things it trusts, or into things it thinks other people will trust. That's why you can see gold and silver lift even when the world isn't literally ending. Second, positioning. Silver has a long history of being under-owned until it isn't, and then it becomes over-owned for short bursts. The transition between those two states is where the fireworks happen. Third, mechanical flows. The modern market is not just humans clicking buy. It's systems responding to triggers. When a price level breaks, systems pile in. When volatility spikes, systems cut risk. When options are mishedged, dealers have to chase. Those forces create moves that feel irrational, but they're actually just rules executing at speed. Fourth, physical reality. Silver is not infinite. It's mined. It's processed. It's demanded by industries that don't care about your chart. And based on recently published industrial production and manufacturing updates, the pull on silver in certain segments hasn't eased the way some people assumed it would. Even if investment demand comes and goes, industrial demand doesn't vanish overnight. Now let's challenge one point that keeps popping up, the idea that silver only rallied because the dollar fell. That's too simple. If it were that simple, every tiny dip in the dollar would create a 15% silver day. It doesn't. A falling dollar can help, but it doesn't explain the intraday violence. The intraday violence is about structure, liquidity, leverage, and where the landmines were placed on the order book. So if you want to be smarter than the average headline reader, stop asking, what was the story, and start asking, where were the traps? Because today had traps everywhere. The trap for shorts was above the prior highs. Once price pushed, shorts that were comfortable suddenly weren't. They had to cover into strength, and that buying becomes gasoline. The trap for late longs was the top. People bought the breakout late, and when it reversed, they were instantly underwater. Then their stops triggered. Then margin pressure triggered, and the selling becomes gasoline in the other direction. This is why I keep saying silver is a teacher. It teaches you risk management whether you want the lesson or not. Now, let's talk about the other metals for a second, because they're not just background noise. Gold running to new records tells you capital is still looking for protection. And when gold runs, silver often feels permission to run harder. But platinum and palladium getting hit while silver spikes tells you something else. Not all metals are being treated the same. Some of that is positioning. Some of that is industrial narrative. Some of that is just who was crowded where. And that divergence matters because it can be a sign that silver's move wasn't purely metals up. It was silver-specific stress. Now, I know some of you are thinking, so what should I do right now? I'm not going to pretend there's one answer that fits everybody, but I can tell you what I'm watching, and you can map it to your own situation. If silver holds above $100 through the week and the pullbacks get bought quickly, that supports the bullish framework. This was a violent test, not a collapse. If silver loses $100 and the bounces look weak, that supports the skeptical framework. This was a blow-off, and we're entering a cooling phase. And yes, cooling phases can still be bullish long-term. A reset doesn't kill a bull market. It can actually make it healthier. But it can also break the people who came in late with too much size. So if you're managing risk, don't manage it with hope. Manage it with levels. And I'll say this because it needs to be said. If you're successful, share your success story in the comments so others can stay motivated. People watch these videos quietly and they think they're alone. They're not. Your story might be the thing that keeps someone steady. Now, let me zoom out for a second and give you the why this matters layer. A one-day spike is exciting, but what matters is what it signals about the broader system. When a commodity like silver can do this, it tells you liquidity is thinner than people assume, and it tells you financial conditions can tighten fast if the wrong pressures build. It also tells you that inflation psychology isn't dead. Even if official numbers cool for a while, the fear of currency erosion comes back the moment policy credibility wobbles. And there's another angle that doesn't get enough attention, the supply side. Silver supply doesn't ramp like software. You can't just turn on more silver. It takes time. Projects take years, permitting takes years, capital takes years. And if higher prices are what it takes to justify new supply, the market can overshoot before supply responds. That's not a prediction. That's just how commodities behave. Now, that doesn't mean price goes straight up forever. It means volatility is part of the package. And today was volatility with the volume knob snapped off. So where does that leave us heading into the rest of the week? It leaves us in a place where headlines will try to control your emotions. One outlet will tell you silver is going to crash. Another will tell you it's going to the moon. Both are selling certainty, and certainty is expensive. My view is simpler. The market just showed you it can reach $117.84. That is now in the universe of possible outcomes. It also showed you it can erase a big chunk of that move in hours. That is also in the universe. So the question is, which outcome is more likely next? Here's my base case, and I'm saying this as a framework, not a promise. After a day like this, the market often chops. It shakes. It tries to frustrate both sides. That's how it resets positioning. That's how it cools euphoria without collapsing the entire trend. But there's a risk, too. If policymakers surprise the market, or if there's an ugly political development, the chop can turn into another spike. Either direction. And that's why you don't want to be over-leveraged right now. Not because you can't win, but because the win can turn into a loss before you can blink. Now, I want to circle back to the half price later idea, because it keeps getting repeated and it deserves a reality check. Could silver be dramatically lower later? Absolutely. Silver can do that. But half is not a forecast, it's a scenario. And scenarios depend on conditions. For silver to be half of today's levels, you'd likely need some combination of tighter financial conditions, a stronger dollar, reduced speculative demand, and enough easing in inflation fears that people rotate back into cash and bonds confidently. Is that impossible? No. But it's also not automatic. And here's the counterpoint that doesn't get said enough. If the world is moving into a period where industrial demand remains firm, and if the monetary environment keeps rewarding hard assets, then deep pullbacks can become buying events rather than trend killers. So if someone tells you it must crash, ask them, what's your mechanism? What changes in policy? What changes in liquidity? What changes in demand? Because without a mechanism, it's just a vibe. Now, let me give you a quick mental checklist for the next few sessions. When you see the chart, don't just look at price. Ask, is the market making lower highs and lower lows on increasing volume? That's distribution. Is the market pulling back on low volume and snapping back on higher volume? That's accumulation. Are we getting big wicks both ways with no progress? That's indecision. And indecision usually resolves with a violent move. And if you're watching from the sidelines, that's fine. Sometimes the smartest trade is waiting for clarity. There's no trophy for being first. There's only money for being right enough with controlled risk. Now, another quick reminder before I wrap this up. The description has those bonus links, including the premium WhatsApp channel and the membership join option. If you want the extra updates, that's where it is. And again, if you're successful, share your success story in the comments so others can stay motivated. That's not fluff, that's community. All right, final tease before we land the plane, because this is the part that will decide what kind of week we're really having. If silver can reclaim the mid-110s after this pullback, even briefly, it tells you buyers are still aggressive and the market is not done testing the upside. If silver can't even hold $100 and starts closing below it, it tells you the squeeze is over for now and the market wants to reset lower. Either way, today was not normal. And days like today are the days you study, because they show you the wiring behind the walls. So tell me in the comments, was today a warning shot or the opening act? Hit like if you want me to keep tracking this day by day through the rest of the week, and subscribe if you want more breakdowns that don't insult your intelligence. And my standard reminder, I'm sharing my analysis for educational purposes only. I'm not your financial advisor, I don't know your situation, and nothing in this video is a personalized recommendation to buy or sell anything. Do your own homework, manage your risk, and make decisions you can live with.